What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today we have a special guest, Tim Dineen. Tim is with Keystone Funding. He's really passionate about helping investors and his clients when it comes to financing their deals. And today we're going to ask him a few questions about what he's seeing in the lending markets and just how I'm going to ask some questions about what goes into getting some loans. And these are questions that I get quite often from my clients. So it's going to be great to have a professional here with us to help clarify some things. And hopefully I've been telling people the correct information. So Tim, if you don't mind, if you want to tell us a little bit about yourself.
Sure. Thanks, Ryan, for having me. I'm excited to share anything I can that will help investors navigate the markets better and build wealth. But I've been doing this about 11 years now. The majority of my career was with primary residents and first-time home buyers. And the last couple of years, I've gotten really deep into investing, both myself and with helping other clients. So I'm extremely passionate about teaching investors how to find money, how to find deals, and really just doing it together. So I'm excited to share.
All right, awesome. I appreciate that. So I guess one of the first things I wanted to touch on a bit is just what sort of impact have you noticed on your investor clients these last couple of years with first interest rates shooting up and then the Fed started to pivot, but that didn't really change a whole lot. And then what you're kind of seeing now, if things are changing from that trajectory at all from on your side.
So I'll kind of take those questions backwards. So on the Fed trying to help and things pivoting, we all understand and we all look at and believe the headlines that we see. So if you go back to mid-September when there was the Fed meeting where they dropped rates by 50 basis points, the improvement had already been kind of brewing. So from like early mid-August to mid-September is when the real improvement started. And then they make the announcement and then things are flat and actually got a little bit worse. Because as you know, right, there's so many other things that go into it, the jobs data and different triggers that impact the actual retail rates. And then a similar thing happened in November, not as dramatic, but there was a small decrease and things had just been kind of moving flat. And just like with stocks and bonds, or stocks, I should say, the market and speculation, that's what's driving rates.
Yeah.
And then that either meets or doesn't meet with what the Fed announces. So hopefully in 2025, we're going to see more, good news from the Fed that lines up with the speculation, and then you will ultimately drive down more. But I will say over the last month or so, rates have definitely been heading in the right direction. In terms of the what it's done for investors, when the cost of money is more expensive, things are more expensive. And so for long-term hold investors, right, you've got purchase prices up considerably over the last couple of years, rates up double in many cases over the last couple of years. And so it squeezes out cash flow. And then when you have, with the fix and flips, when you have the cost of goods that are up, everything just gets more expensive. So it makes you or me as an investor have to get more creative, have to be more disciplined. And, I have not bought a long-term rental in a couple of years, but I have definitely done a considerable amount of flips. And I've seen people win with short-term rentals and, where you can squeak out more cash flow and just with being more disciplined and seeking out the right investments. So again, if you just go on and you look at the macro data for properties right now, things are expensive. but if you really search, there are deals out there, and there are people that are winning.
Yeah, yeah, definitely. I'm seeing similar on my end for with my tax clients, seeing a lot of or I should say, an increase the last couple of years of sub two deals as well.
That's a
Which,
great point. Yeah.
yeah, which is just for the listeners, a sub two is when you take a property subject to the existing mortgage or debt on that property. So if someone owns a property that's got 3% interest rate, which
Hmm.
I'm sure everyone wishes we still had those, you could essentially buy the property and take over making their payments at that 3% rate. Now it's a bit more uh, involved in that, but that's sort of the gist of it. So I've noticed a lot more of that the last couple of years than I ever had
And
in my career prior.
with the assumptions, with VA assumptions and FHA
Mm,
assumptions, that's a more clean version of subject to. But
yeah.
all of those people that get those deals done are putting themselves in a fantastic position for sure.
Yep. Yeah. Yeah. Definitely. And I've also seen an increase in sellers just carrying paper on a property as well. They just take the note, they'll take the interest as it is, and they become the bank in a sense.
Yeah, I had a friend of mine who approached me. I'm in the mortgage business. I get paid to help people do mortgages. And I had a friend who approached me, I think it was like late 2022. So rates had already gone up
Yep.
significantly. And then you have, Fannie changing the rules and second homes getting more expensive as well. And he was trying to buy a cabin, and he knew the owner, and the owner owned it outright. So I advised him how to structure it, and he got it done way, way cheaper than I could have helped him. And
Yeah.
being a good friend and a good advisor, I helped him do that. But
Yeah. Well, that's awesome.
yeah,
Yeah. Generally, you're not going to get the 25 or
sell it.
30-year term when you take a
Yeah,
seller when you're dealing with seller financing. But
sure.
every once in a while it happens. But
Yeah.
it's always an option out there if you're looking for creative financing. But let's pivot into like the actual sort of loans that you deal with on a more regular basis. When I'm working with a client, sometimes they will come to me and they're talking about, see, okay, I'm going to need to get some financing. I want to buy a new property. I don't know if I want to do this cost seg study and use bonus depreciation because it's going to make my tax return look bad, which is going to be used for my loan. Can you tell us just how you normally handle depreciation? If you're reviewing whether it's a financial statements or someone's personal tax return, if they got properties on their individual return on a Schedule E, how depreciation is looked at from a lender's perspective.
Sure. So I know you know this disclaimer. I'm not the CPA in this meeting. But whether it's business income or Schedule C income or on a rental property on the Schedule E income, right? Whether you're a business owner or W-2 and you have a rental property, depreciation exists to be able to help you lower your taxes, right? And it's a
Yep.
allowable thing, but there isn't necessarily a true cost behind it, right? Like it's not
Correct.
like
Yeah.
you wrote a big check. You just got a benefit. And
Absolutely.
so mortgage companies acknowledge that, and they allow you to do what's called an add back. And so if you had 10 grand in depreciation on your rental property, then you can do a $10,000 add back, and you save that 10 grand off your taxes.
Yep.
Um, but then you can add it back, and we give you more credit for it. So it's a great benefit if you use it correctly.
Okay. Yeah. Awesome. Yeah. And that's what my understanding as well. You actually get to add that depreciation back. So taking advantage of all the depreciation that you're allowed to use isn't going to
Mhm.
hurt you from a lending perspective. Just make sure you do it correctly and
I think,
display. Oh,
yeah,
I'm sorry. Go ahead.
with someone like yourself, right, who's specializes in real estate tax work, I think someone should be confident just telling you to handle it, and you help advise.
Yeah.
But not everyone has a Ryan in their corner, and I think if you don't, it's important that your tax preparer and someone like myself have a conversation before you file your taxes, because there are ways to do it correctly and ways to do it incorrectly that will help you, when it comes time to qualify.
Yeah, yeah, absolutely. Another thing that comes up a lot is timing on filings. So, as you're probably aware in the real estate place, especially for anyone that's investing in through like a syndicated deal or some of these larger deals, that their share of income or loss coming through on a K1, often those K1s don't come out until summertime.
Hmm.
So I'll get questions a lot from clients that they're starting the loan process, and one of the requests is usually, let's see the last 2 years of your tax returns, the most recent years not filed. So then we explain to them, it's fine, just let them know you're on extension. Generally, that's going to suffice. They'll use more recent tax returns, maybe some financial data that's available, and then you can send over the final return when it's ready. Or sometimes you might even get a draft in the interim while you're waiting. Um, is that true on your end? Is that typical, that so those clients don't have to worry about filing a return that's not complete and then amending it later?
Yeah, that's definitely true. I would absolutely not have you go and file something that's made up, if you will.
Yeah.
Um, and then the way, kind of the mechanics of how we would handle someone that's on extension, right? Let's say the due date is April and the extension due date is October, right? So it's really for those people in that 6 month
Right.
or so time frame. And they for right now we're October, or sorry, we're December 2024, but let's say we were in October. You'd have to prove to us, right? Just show the documentation that you filed the extension, and then we would get either 2023 or 2023 and 2022's taxes, depending on the loan program and whether it's 1 year or 2 year taxes required. And if it was an FHA loan, for example, which you're not going to use in the investment space, but if it was an FHA loan, we would need a P&L as well, a profit and loss statement. And then, just to throw out there, I know a lot of your listeners are self-employed, but if you weren't self-employed, or if your spouse qualified with their W-2 on their own, people who are not self-employed or who don't need rental income to qualify, we don't need taxes at all. So, you know, again, this might not apply to everyone, but I try first to figure out what works for the client and what's the cleanest way to do it. And there's no like A plus, right?
Yeah.
We either qualify or we don't. So the least amount of documentation. But for the true self-employed who need the income, who are on extension, you'd be looking at 1 to 2 years taxes is what you need to provide. And then we would go from there.
Okay, awesome. Yeah, then that's typically what we see as well. You show that you filed an extension, give the most recent filed return, and that typically solves it. And like you said, if it, depending on the loan type, sometimes you're submitting a P&L. All right, awesome. So I was wondering if you'd be able to explain to the listeners what exactly a DSCR loan is and how that differs from a conventional loan.
Sure. So a DSCR, and you don't have to worry about memorizing this, but DSCR is debt service coverage ratio. So the debt is the new property that you're buying. And just for simple math, let's say the mortgage on the new property is $2,000, and the rent, either the current rent or the projected rent, is $2,000 on this property. Then that would be a DSCR coverage, a DSCR ratio of 1 to 1, right? $2,000 mortgage, $2,000 rent. And so it's not cash flowing and it's not costing you anything. That is the calculation that is used to see if you qualify for a DSCR loan. And so it's really all about cash flow. You do have to have a minimum credit score, but in terms of like all the other noise on your credit report, like your Kohl's bill and your car loan and your primary residence and other investment properties, they don't doesn't come into play on a mathematical perspective. So DSCR, it's the property and the mortgage. Traditional mortgage, we just touched on with the taxes, but a traditional mortgage is basically analyzing your personal household finances, right? What is my
Gotcha.
income per the IRS versus what are my debts, right? My $3,000 mortgage, my $500 a month car payment, my student loans, my Old Navy bill, all that stuff, is calculated in there. And that's why you're getting the best interest rates with a traditional Fannie Mae Freddie Mac mortgage because it's the most level of scrutiny and it is backed by Fannie Mae and Freddie Mac,
Gotcha.
where the DSCR loans are a little bit more forgiving, but there's a slight premium in that as well.
Gotcha.
Yeah.
Okay, awesome. And what about bank statement loans?
Yeah. So I would say a bank statement loan is like the adjacent to the DSCR.
Okay,
Um, you're going to still do an appraisal. You're still going to get the rent roll on the property, right? The projected rent that's on there. But the income is calculated by what's on your bank statements. And I'll give you just a
gotcha.
quick, the money in that is, right? And if you have, it's important if you're getting a business bank statement loan and, with Ryan as your CPA, he could get a plan together for over the next 12 months. Make sure your bank statements are clean and you're using the same ones for all your business transactions. The example that I'll use, I had a roofer who, after all the calculations on the um, traditional Fannie Mae calculations, he made about $5,000 a month. But then when we did the bank statement calculations, obviously there's a lot of material costs in roofing,
Yeah.
but the amount of cash flow that he produced, we gave him something in the ballpark of like $50,000 a month to qualify,
Oh,
right? So
nice.
just like total game changer. Again, you pay a little bit of a premium in rate, but he went from being a renter to being a homeowner.
Yeah.
And with bank statements, you can do primary residence or investment property. DSCR is just investment property. And then
Okay.
one more thing that I wanted to add, um, Fannie Mae, Freddie Mac, any of the traditional stuff does not allow you to buy the home in your LLC. Um, Bank statement and DSCR on the investment side allows you to buy it in your LLC if
Okay.
you'd like.
Awesome. All right. Good deal. No, that's very helpful. Very good information. I've been asked to explain what a DSCR loan is a few times myself, and I know the gist of it, but it's nice to have someone like you to call up to just get
Yeah.
some of the
And I
additional details.
and I say, right, like you buy your primary residence because it feels good and you like it,
Right.
and
Yep.
hopefully it fits for your budget. But DSCR, if it doesn't cash flow, it's going to tell you, right? And if it doesn't cash flow, do you really want to buy it?
Yeah. Yeah,
Yeah.
exactly. You don't want to go into a deal
Yeah.
just because you're excited or you fall in love with the property. You got to
Yeah.
turn that off. Especially, I mean, you should be able to do that with a primary residence. I know that's easier said than
Sure.
done sometimes, but
Sure.
definitely on an investment property,
Yeah.
like let the numbers tell you what's happening. Don't get emotionally attached.
Exactly.
All right, awesome. Well, I do appreciate all your information here. Just to pivot a little bit, talk a little bit more about you. Wondering if you have any hobbies or interests outside of work that you enjoy.
So I have gotten really serious about my health,
Nice.
and today was my 250th day at the gym, and I'm part of like a group gym. Shout out to Burn Boot Camp. But
Awesome.
no, they made it like a big deal when you hit 250, and today was that. So that's and my wife does it as well. So that's been our the last couple of years. But that's been my hobby, I guess, is going to the gym.
Yeah, that's awesome, man. Congratulations. 250
Thank
days
you.
straight. That's awesome.
Yeah.
Yeah, I try to get to a gym at least a few times a week. It's tough
Yeah.
when you're
I
busy and
all I also I was a big fisherman when I was a kid
oh,
and
nice.
haven't really done much since. And this past weekend I went out with some friends in Delaware and we caught a tuna.
Oh,
Uh,
awesome.
yeah. Yeah.
Where'd you go in
So,
Delaware?
outside of Lewis, Delaware,
Okay.
like near Bethany Beach.
Oh, yeah,
We,
yeah.
we
Okay,
we
awesome.
went 30 miles offshore. So it was
Gotcha. Nice.
yeah, a lot of work to get out there, and then luckily it was quick and we got back. But it was I would love to do more fishing for sure. How about
Yeah, that's
yourself?
awesome. What hobbies or fishing?
Whatever.
Yeah, hobbies. Well, started training jujitsu several months ago, so I do that a few times a
Nice.
week.
Nice.
And then my daughter's 3, so that keeps me busy a good bit.
Awesome. Awesome.
She's into swimming, and my wife just got her signed up to do some dance. So, in fact,
Nice.
we've got to go into swimming later today, so swimming
Yeah.
lessons. But yeah, so that keeps me pretty busy.
Nice.
Yeah, I went fishing. Was that last? Yeah, it would have been last December. We were in Mexico, and it's not a swordfish. What is a fish that looks like a swordfish that we caught?
Like a sailfish or
Sailfish. That's it. Yeah, it was
okay.
sailfish. Yeah, we
Okay.
were down in the bay down there, right, or in the ocean because we were on the Pacific side and
Nice.
caught a sailfish. So that was a good time.
Nice.
I have a little video of me reeling it in. So that's the
Oh, that's awesome.
only time I've caught anything bigger than like a little
Yeah.
little
Yeah.
fish from being a kid. But it was a
That's
good time.
awesome.
Yeah.
Good. Good. Awesome.
All right, man. Well, I appreciate your time. That we're kind of coming up on time here, but I really appreciate you jumping on with us and taking the time to explain some of the loan scenarios and different loan types out there. We'll have to do it again sometime.
Absolutely, man. I'm here to be a resource and can help with anyone that needs it.
All right. Well, I appreciate it. Well, everyone, I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. And until next time, have a great day.
Take care.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulisgroup.com/contact. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy.